Another week, another opportunity. Hi everyone, welcome to Intelligent Investing. I'm April Tan, Chief Equity Strategist of COL Financial. The Philippine Stock Exchange Index fell for the second straight week, dropping 71.57 points or 1.1% to close at 6,341.53. Market breadth was negative as there were 116 decliners versus 105 gainers. Foreign investors were net sellers by 14.9 billion pesos. However, if we exclude the block sale of RRHI shares, foreign investors were actually net buyers by 906 million pesos. Now let's look at our top index gainers and losers. The top 5 index losers were JFC down by 8.2%, SM down by 5%, SMPH down 4%, AEV down 3.5%, and DMC down by 2.6%. What's surprising is there were no clear catalysts for the decline. In fact, AEV dropped despite its inclusion in the MSCI Small Cap Index, likely due to profit taking as AEV went up prior to the deadline. Meanwhile, the top 5 gainers were AGI. So this stock has been recovering since April, and last week it went up by another 18.6%. MONDE up 13.1%, CBC up 4.3%. Both stocks rebounded from previous declines as MONDE was sold off recently because of its weaker than expected first quarter earnings. On the other hand, CBC suffered from profit taking after rallying strongly earlier this year due to its inclusion in the PSEi index. Bloom up by 3.7%. This is despite being removed from the MSCI Small Cap Index. Bloom rallied last week driven by optimism over its e-gaming platform launch that is expected to happen this month. And finally, we have JGS up by 2.9%. JGS has been on an uptrend since February after disclosing plans to indefinitely shut down its money-losing petrochem unit. What's puzzling is the Philippine market fell despite a strong rebound in US stocks last week. The S&P 500 and Nasdaq rose 1.9% and 2% respectively after President Trump delayed the 50% tariff on EU goods from June 1 to July 9. On top of that, a federal court initially ruled that Trump overstepped his authority with the tariffs. However, a day later, an appeals court reinstated the tariffs, adding another layer of uncertainty for investors. So this means we're not sure if the tariffs will be removed or they will be kept. Now we have 3 interesting stories to talk about, and coincidentally, all 3 companies are owned by the Gokongwei family. The first company is URC. So in May, Capital Group, which is a highly respected global fund manager handling $2.8 trillion in global assets, bought a 5% stake in URC. That's a vote of confidence in URC's long-term fundamentals and attractive valuations, as URC is currently trading at a steep discount compared to its historical average PE multiple. The next company is RRHI, or Robinsons Retail. So RRHI bought back 22.2% of the company from its major foreign shareholder GCH at 50 peso per share, or 36% above its market price. Although RRHI paid significantly more than its market price, we still think that it's cheap, given RRHI's fair value of around 82.9. Now, there are positives and negatives here. COL's analyst Denise Joaquin expects RRHI's EPS to potentially rise by another 14% next year because of the reduction in the number of outstanding shares. However, because of the huge buyback, RRHI's market capitalization will fall below 50 billion pesos, which could cause some fund managers to trim their holdings in the stock because it's now a much smaller company. Finally, we have Cebu Pacific signing an MOU with Flyadil of Saudi Arabia to lease aircraft seasonally. We view this favorably as this could lead to improved operational flexibility and capacity utilization, ultimately leading to greater profits. Note that Cebu Pacific usually books weaker earnings in the third quarter because demand for travel is much weaker. And of course, plane fares go down because of that. On the other hand, demand for flights are very strong during the fourth quarter, but then Cebu Pacific does not have enough capacity to maximize on the strong demand. Now, some telco news I want to tell you about. as we're seeing what could be one of the most disruptive shifts in the Philippine mobile market. Dito Telecommunity, the country's third major telco, is quietly but steadily gaining market share. That could mean trouble for number 1 and number 2, Globe and PLDT. Globe and PLDT both posted disappointing mobile revenues in the first quarter, with Globe down 3% and PLDT down 1%. According to them, this was due to weak consumer spending driven by high inflation, heat-induced class and work suspensions, and a recent transport strike. However, the concern is that Dito's growth is also partly to blame. If so, the threat is more permanent and will make Globe and PLDT less attractive to investors, as 65% of Globe's total revenues come from mobile and 42% for PLDT. While Globe and PLDT's mobile revenues were down, Dito's mobile revenues soared by 35% in the same quarter, making them hold 8% of industry revenues as of March 2025, up from 6% during the same period last year. And in a mature market, growing just 3% a year, a 35% increase by a player with an 8% market share is already a huge deal. Right now, Dito has a 10% market share in terms of subscribers after being in operation for almost 4 years. So what's driving consumers to Dito? It all comes down to value and flexibility. For example, 99 pesos worth of load is valid for only 7 days with Globe and PLDT, while the same amount can last up to 30 days with Dito. You can also buy a 50 peso no-frills data load that will last for 7 days, which is not possible for Globe and PLDT. If Dito's momentum continues, Globe and PLDT may be forced to reintroduce smaller top-up denominations, which could lead to lower average revenue per user, lower overall mobile revenues, and a more competitive and less profitable industry. But Dito isn't out of the woods yet, as it lost 4.6 billion pesos in the first quarter. Fortunately, they're finalizing a deal with Summit Telco, who's acquiring 9 billion shares, although the price is not yet available. But even then, this amount that Dito will raise may not be enough to keep operations afloat if it can't reach profitability soon. According to Dito, it is targeting to be profitable by 2027. In summary, Dito's aggressive growth and more affordable pricing are putting pressure on Globe and PLDT. This could reshape the telco landscape over the next few quarters. So intelligent investors, keep an eye on subscriber trends, pricing shifts, and the next earnings cycle. As we wrap up our show, here's what to watch out for this coming week. Here at home, we have the May inflation report that will be released on Thursday. The BSP hinted at 2 more 25 basis point cuts this year. May inflation, which will be announced later this week, is expected to be just 1.3%, according to consensus estimates from Bloomberg. If that comes through, a rate cut on June 19 becomes even more likely. But global risks remain as the BSP continues to watch developments in the US, especially with how Trump's tariffs might affect inflation and the Fed's actions. The peso needs to stay competitive, so the BSP can't get too far ahead of the Fed. Because if the interest rates on peso assets are too low, then investors would rather own US dollar assets and the peso would depreciate sharply. Next is Powell's speech on Monday and US jobs data that will come out on Friday. Fed Chair Jerome Powell will have a speech on Monday, and the May jobs report will come out on Friday. Markets expect 130,000 jobs added and the unemployment rate to hold at 4.2%. A stronger than expected number could dampen hopes for a rate cut, which is negative for equities, which likes lower interest rates. That's all for this week. If you found this market rundown helpful, don't forget to subscribe for more market insights every week. A new week is a new opportunity. Remember to stay sharp, stay selective, and as always, invest intelligently.